India's currency crossing the 97 rupees per dollar mark is not just another financial headline. It is a warning signal for the entire economy. This crisis is affecting fuel prices, inflation, imports, foreign education, investments, and even middle-class aspirations. But this collapse did not happen overnight. In this video, we will decode how war, oil dependency, capital flight, and structural economic weaknesses combine to create what many analysts are calling the 2026 rupee fracture. The symptom is clear. The Indian Rupee, INR, is Asia's worst-performing currency, with a cumulative drop of 11.9%. It has breached the psychological $97 mark, decoupling from broader emerging market resilience. The 2026 rupee crisis is not a temporary market fluctuation. It reflects years of accumulated economic pressure finally erupting under global shocks. India's growth model remains heavily dependent on imports, especially crude oil, electronics, and industrial inputs. As external crises intensified, these underlying vulnerabilities became a full-scale currency crisis. This crisis is essentially the collision between global instability and domestic structural weakness. The rupee collapse was not caused by one isolated event. It was the combined impact of four simultaneous global shocks. First, crude oil prices surged above $110 per barrel, dramatically increasing India's import bill. Second, massive foreign investor withdrawals created severe dollar shortages inside Indian financial markets. Third, a strong U.S. dollar globally weakened emerging market currencies across the world. And finally, the U.S.-Israel-Iran conflict disrupted the Strait of Hormuz, one of the world's most critical oil supply routes. India imports nearly 85% of its crude oil. So when expensive oil, global uncertainty, and capital flight collided together, the pressure on the rupee became overwhelming. The crisis exposed three major structural weaknesses inside the Indian economy. First, the trade deficit. India consistently imports far more goods than it exports, especially oil, electronics, and gold. Second, remittance leakage. Outward remittances by Indians have increased sharply, creating continuous demand for dollars. Third, dependency on foreign capital. India relies heavily on foreign portfolio investments to finance imports and stabilize the currency. This creates a dangerous vulnerability because the rupee's stability becomes dependent on global investor sentiment rather than domestic economic strength alone. Normally, central banks defend their currencies using foreign exchange reserves. But in 2026, the RBI faced a serious limitation. The RBI already held over $100 billion in future dollar obligations through forex swap arrangements. This created what analysts called the forward book paradox. If the RBI aggressively spent reserves today to defend the rupee, it risked weakening its ability to fulfill future dollar commitments tomorrow. In simple terms, the RBI was trying to stabilize the currency while already carrying massive future liabilities. NDIA experienced a major currency crisis before during the 2013 taper tantrum. But the response in 2013 was far more aggressive. Special NRI deposit schemes attracted billions of dollars. Interest rates were raised decisively. Investor confidence recovered quickly. In contrast, the 2026 response appeared far more cautious. Repo rates remained mostly unchanged. Dollar inflows were not mobilized aggressively. Reserve selling became the primary defense mechanism. The comparison highlights the difference between proactive stabilization and reactive defense. A falling currency eventually becomes a household crisis. Petrol, diesel, medicines, imported electronics, and international services all become more expensive. Middle-class aspirations, such as overseas education, foreign travel, and dollar-based subscriptions, suddenly become significantly costlier. However, families receiving remittances from abroad experience temporary relief because each dollar converted into more rupees. This is where macroeconomic instability directly impacts ordinary citizens. Traditionally, governments manage oil shocks by increasing domestic fuel prices. But in 2026, the speed of rupee depreciation neutralized most of those gains. Even after fuel price hikes, the falling rupee sharply increased the actual landed cost of imported crude oil. As a result, oil marketing companies remained under severe financial pressure. Inflation stayed elevated. Government pricing mechanisms became increasingly ineffective. The currency depreciation itself began overpowering policy interventions. The rupee collapse created uneven effects across industries. Worst-hit sectors: aviation, ceramics, specialty chemicals, polyester textiles. These industries depend heavily on imported fuel or petroleum-linked raw materials. Beneficiary sectors: IT services, pharmaceuticals, export-oriented manufacturing. These sectors earn revenues in dollars while operating largely in rupees, allowing them to benefit from currency depreciation. So while inflation hurt consumers, some export-driven industries gained competitiveness globally. The government and RBI primarily relied on defensive measures, selling forex reserves, conducting forex swap auctions, restricting outward remittances. However, stronger structural measures were delayed. Higher interest rates, NRI bond schemes, incentives for foreign investors. Critics argue that the strategy focused more on slowing the fall rather than restoring long-term confidence. To stabilize the rupee quickly, analysts proposed 3 urgent measures. First, mobilize NRI capital. Launch emergency NRI deposit schemes to attract billions of dollars rapidly. Second, sovereign dollar bonds. Raise foreign capital directly through overseas government-backed bonds. Third, strategic rate hikes. Temporarily raise interest rates to attract investors and discourage speculation against the rupee. The primary goal was restoring market confidence before panic became irreversible. Long-term currency stability requires structural transformation. India must reduce dependency on imported energy, expand high-value manufacturing exports, strengthen domestic capital markets, build larger strategic energy reserves. The ultimate objective is to transition from an economy that imports consumption to one that exports value. Only then can the rupee become structurally resilient against future global shocks. There is a critical difference between a strategically weak currency and a rapidly collapsing currency. A controlled weak currency can improve export competitiveness and support manufacturing growth, but a rapidly falling currency creates imported inflation, uncertainty, and economic paralysis. The 2026 rupee fracture is therefore more than just a currency crisis. It is a warning that India's economic model is approaching a transition point. The long-term solution is not endless RBI intervention. The real solution lies in fundamentally restructuring India's external economic architecture for a far more volatile global order.